This is Chris Brecher with Simpler Trading and also the Simpler Stocks Mastery. I'm thrilled to be on with you, and I wanted to let you know what we're going to talk about. I only have a half an hour, which is a little rough to go over everything, but I want to show you some correlated indexes, and I want to show you just a little examples of how I try to trade. So what I'm talking about in here is there's probabilities. And so I'll show you the probabilities. But the first thing I want to show you, I'm doing a class and I'll mention all the prices and all that at the end. But I'm really into bull flags, bear flags, and a bear flag that looks like that. Yeah, I drew that a little crazy, but has a horizontal bottom to it. I didn't have mimosas for lunch, but that very good pattern as a bearish pattern. So I wanted to show you, most people know what bull and bear flags are, but you don't know how to trade them. So there's your bull flag a couple of days ago. Yeah, but went up by that amount. It's a consolidation pattern. A lot of people get it wrong with these bull and bear flags because what happens is it's a consolidation of a previous move. So if you see a move down and then like that, that looks like a bull flag. Now, the previous big move was down. And that's why I have this chart up here. So the first thing I want you to see is what happened on Wednesday in the middle of the night. So you couldn't jump on this, but this is a great example. So a bear flag, you see the previous move right here, that previous move down. So if you're a futures trader, you could do this. Now, keep in mind that the charts I'm showing you work with futures. You can apply options, you can apply stocks. The beauty of options is futures is you can put in stop orders basically 24 hours a day. After hours, you can't put in stop orders on the ETFs like SPY. Very frustrating. So this is what I want to show you. So you see this, that's a potential bear flag right here. Now, I call this a slumbering bear flag because it took some time to develop. On the left, that looks a lot sharper. That's an hour chart. Now, the thing is, this is ideal. The ideal pattern is for something to break because you're not sure when it's going to break, and then it forms a bear flag under that break. That is a given. And then here, horizontal trend line. That's a ledge. Now, why am I showing this? Because I like to look at a farther out time frame to confirm what I'm doing. So if I saw a bear flag when this looks like a bull flag, forget about it. But this had already gotten under something. Now, I could get into the ATR trailing stop, which I use a lot, but I'm just showing a simple moving average. Just a simple moving average to give you the point that this was more likely to work if a longer term time period of the same chart is under something. So if this was way up in the stratosphere, it's a little more dangerous. Just keep that in mind, like this. Yeah, that wasn't the best one in the world. You might have made a little, but you really could have gotten yourself hurt. So I just wanted to show you on how those work. So that to me is pretty cool to show you right there where one of them happened like that. So right there. So I'm not Mr. Perma Bear, but this is one thing you have to keep in the back of your mind. I also look at a lot of fundamental stuff. What I mean, though, by fundamental is a little different than other people. But if I see interest rates on a 2-year go from 0.2% last year to 4.7 now, guess what? Well, there's alternative to stocks. What that means, it doesn't mean you can't go up. What it means is bearish patterns are more likely to work and markets are more sensitive to the bonds. And this is why bear flags have been really working in the last year. So this is the bond market, and I could show you a 100-year chart, but I'll just show you a monthly. It doesn't go back that far. And this is the first time that this has broken decisively a trend line. Now, this is a monthly MACD. You can use any kind of oscillator you want. It would show you the oversold, but it would show you the break. And because of that, now it's really hard for stocks to have massive rallies. They can have short-term short-term bear squeezes, no doubt about it. But this is what I want to show you because this is the fundamental part. The fundamental part is this. You take the ES or the SPX for that matter. One thing is it yields about 1.7%, while you can go get 4.7%. That's one reason the market's done what it did last year. The other thing is you run against price earnings now. So there's a historical price earnings from so-and-so to so-and-so. The lower the interest rate, the higher the price earnings is. So when you get into high PE stocks and interest rates start going up, they start nailing the stocks that have either a high price sales or high PE. Like ServiceNow, yeah, 700 to 350. Great company, but you have to value it according to the interest rates. As you see, the slope was the same. That brings me to the SPX. So many people, including me sometimes, are looking at this trend line on the right and saying, if that breaks, yeah, now we're in a new paradigm. Well, I'm not sure about that, and I'll show you why. A lot of analysts, the most bullish, are saying an earnings per share of about $230 on the SPX. And they're taking like an 18 PE. That gets you to 41.40. Well, guess what? You're at 40.35. The risk reward stinks. Doesn't mean you can't have a nice little rally in here, but I'm just telling you, this PE is not going to go up if the bond market doesn't rally. That's all I mean in here. So, in there. So, and thanks for asking about if I'm well. Yeah, I had emergency major back surgery, and I sent trades from the hospital bed to Lorna, and she was nice, so nice to post them for me. A lot of them closing and one of them opening. So, yeah, I'm doing much better. So this is the other thing, though. You're bouncing up against PE. And that's why the bond market action becomes so important. If this bond market has a rally all the way to here, it could still be in a new bear market, but that's 2 percentage points, and you could have a massive ES rally. But you don't have that yet. So just keep that in the back of your mind. That's one thing. This is the other. I do things on TradingView. I call them bubbles. Now, I'm into correlations a lot, whether it's like NSC versus UMP, two railroad stocks. But somebody on the free side asked me a great question when I first started on the site. What's the difference between correlation and companion stocks? So companion stocks are stocks in the same group. Correlated stocks can be completely unrelated, but they've been correlating lately. So that's a great question. And this is why I'm looking at this. I move over all my screens here. There you go. So here's the bond futures on a 1 hour chart. 1 hour chart. So as you see, they've had a little bit of an uptick in the last hour or two. But right here is that circle is January 24th. On the right, this is the ES at January 24th. Right in there. So this is a little higher than this. Not a lot. And then it comes down to the point of no return. So as you see, you have that and you have that. The point of no return is if these bonds get all the way down to like the bottom of that circle. To me, that's a big divergence between this and this. So that's why when I'm looking at bull or bear flags, the first thing I do every morning is I watch to see how these are in relation to each other. So you might ask, well, why here? Because look at like a 4 hour chart. Look at the rally in the ES and the rally in the bonds. It's correlated pretty darn well lately. As you see, pretty darn well. But when did the bonds start going down? A lot last year, and so did the ES. Now, if you hear any of the talking heads on CNBC saying the bond prices and stocks go together, just keep in mind that they go together at the beginning of an economic recovery because interest rates go up because the economy is getting stronger and stocks go up. It's the second leg down that is curtains for the markets. You see it here. So the bond market went down, stock market went up. That was in the COVID Fed pumping everything. This stabilized, and the next leg down is what nailed the S&P. It's just amazing. So, and just keep in mind, the first leg down usually corresponds to an economic recovery. Now, the problem is that now you got inflation. So that's why I keep looking for bear flags. So, and if I see bull flags intraday, great, like I said. But this is what I'm watching today. Just if you're day trading today, I'm watching the 5-minute chart of the bonds versus the ES. So when the bond, I mean, look at this. You can see it a mile away. The bonds rallied, the ES rallied. The bonds rallied, the ES sort of rallied. The whole point is if these bonds go back to here, I got to think the ES is going to go to here. Now, I'm not sure of that yet. Maybe the bonds have a miraculous rally. As you see, they're really rallying. But what I try to do is if this is rallying, I'm looking for bullish and bearish ideas. And the reason is the bonds haven't really broken down, but they haven't broken up. So I'll look at both sides of the coin. The yield curve, I think, is a big deal in the long term, but it's not going to help me trade now. But yeah, I think that's a big deal. And I think people are underestimating how much of a big deal. It's like the slasher movies. The big person, the bad person's coming out. You just don't know when. But yeah, I think that's going to be a big deal. Just keep in mind, though, that usually when the yield curve inverts and you get a recession, if the bond market rallies and the yields plummet, usually markets go up no matter what. So 2000, 2008 were a little different, but usually then there's a big positive divergence between bonds and stocks, and then stocks start following. But for now, I'm not going to worry about that. I'm going to worry about this right now. Right now, you're seeing something a teeny bit different. Darn, I wish I was on longer. You see the bonds going up, and now the ES isn't. So now what am I doing? I'm going to look for bull and bear flags. So let me show you the way I'm going to do it. I'm going to take this away, and here's your thinkorswim most people are familiar with. And all I'm going to do in here is I'm going to go to a scan. Now, before you see all of those, don't worry about that. This is the easiest scan I know. It's a 5-minute consolidation. That's it. It's one factor. It's a squeeze on a 5-minute. Not a bull squeeze or a bear squeeze. It's just a squeeze. So most bull and bear flags are squeezes. A lot of squeezes, though, aren't bull or bear flags. But this alerts me to stocks that that are consolidating. So I'm not a perma bear nor a perma bull. Now, let me just tell you, if right now I saw the ZB on the upper left go from -01 to -16, I'm going to jump on the ones that seem to be developing bear flags and vice versa. But when you do this, I take my main list, and let me share that with you. All I'm taking is the most active stocks, or if there's a stock that, a group that all of a sudden is really in the news. So let me share this with you. If you didn't have this already, I know a lot of you have it. There. So that's my main list. Now, why do you have a main list? Because if I did that scan and did all stocks, I mean, my goodness, there's 2,000, 3,000 stocks. And then you get the ones that are $1. And of course, they don't have a lot of volatility. So they're consolidating. So this is just my main list. And then I press scan. So there are 26 stocks. Maybe none of them look good. Now, if we did this last Friday, and I'm going to say this is 26. And then I'm going to go to on demand. I was just thinking about this and going to last Friday when Dollar General popped out in front of everybody on the live chat. Yeah, I wish I could go to November of 23. So I believe it was the 20th. So I'm going to go to just the end of the day. And I want to take a chart of Dollar General. We did this on that scan. There you go. Remember that one? Yep, that came out clear as day. So that was from the results last Friday. So we got that. There were about 10 of them, and none of them looked this good. See, it was in a bull market already. So I bought stock there, like I told you. I sold stock here. The better play was those calls we talked about because it's expiration day. The 230 calls were 15 cents and they went to $1.25. So pretty exciting at the end of the day. That's a bull flag. So I just want to show you that we did that, and that was actually in the free room on Friday that we did the scan I'm going to show you. Because if it stinks today, at least you know it did work. So now we're going to go back to that scan. Should be about 26 stocks. Then I'm going to save that as 26. I usually add 7 because 7's a lucky number. Then I go into this 26777. And then what I'll do is I'll just link them, and then I'll look at like a 15 and a 5. This is a 5-minute squeeze. So that's what I'm doing. As you see, Dollar General slop today. I'm looking for good setups. So let's see if there are any. No. All I'm doing is trying to find that tight consolidation. Now, you might have that, but let's see if there's one that shows better. No. Like I said, they could be bullish or bearish. And that's the other thing, a real big thing. Dollar General, if you went back to it, it had no resistance overhead. So the bull flag was more likely to work. This has a ton of support. So a bear flag's less likely to work. So that price support and resistance matters. On the class I'm doing, though, I'm not just going to talk about price support and resistance. There's also support from Fibonacci, moving averages, VWAP, and all that stuff. And that doesn't mean to blindly buy there, but it means, you got to respect that area. So just to let you know that. So let's go through. HubSpot. Maybe. I don't know, but maybe. Not the same tight pattern like Dollar General. In fact, let me do this. Let me see if I could share it. I'm going to go back to on demand, and I'm going to put Dollar General in here if it lets me. And I'm just going to take an image of this just so you have it. I'm not sure it'll go on there, but this is just such a good chart to show as a reference point. I mean, that's I love when they're that tight. So compare that to what I'm showing you now that's sort of slop. So let's just go through them and see. No, that's more a bear flag. Not really. See, you can't really say that's a bull flag because you had this red candle. Also in the class, I'm going to be talking about big red candles and big green candles. When you see a big red candle, any kind of bull flags after that happen are going to be suspect, just to let you know. No, see these, they're just not there. Maybe, but they're not as tight as the others. The other thing on a flag, bull or bear, I don't like those. I don't like those reversal candles. It makes the bull or bear flag, bull or bear flag much less reliable. The other thing, so many look for tops and bottoms. 80% of patterns are consolidations. Just keep that in mind. So this is what I've been doing for 40 years. And when I was 8 years on the CBOE, I played flags. It's such a go-to pattern because it has a measuring objective and they usually resolve really quick. See, if this goes down on the upper left, then I'm going to look to short that because at least there isn't a lot of support till here. It's not a great risk reward. But let me just show you a few more and see if any of them look good or bad. Hey, after a reversal candle, I'm going on probabilities. And after a reversal candle like that on a one-time longer period, when I see a bull flag, I don't trust it because it seems like on a longer period, it sort of has, it just doesn't have the same kind of tight pattern as Dollar General. There you go. Now, why aren't I going to play Citigroup on the downside? That's a Brecher ledge because if I'm right, I'm going to make 20 cents. It's not worth the emotional turmoil. But I think you're noticing something. I hope everybody's noticing something in here. No, I do overnight. We've been long Newmont now for months, and we've been long some other stocks for months. So no, it can be with stocks. It can be. The problem is when the Fed's tightening, bullish patterns are less likely to work, so the swing trades don't work as well. And that's the only reason I haven't shown a lot of long swing trades lately. I've had to tighten up my time frame. But what do you notice about today? All these red candles. There are a ton of red candles. What's that mean to me? Doesn't mean you have to go down, but what it means to me is it's really hard to reclaim that candle. So I'm just going on probabilities. Now, this one looks like it wants to try to get above it. But look at the last red candle, how long it took it to repair the damage, even though it had little bull flags in there. So this one might work, but I'm just telling you, there are a ton of red candles today. And that's what I do. So I have a couple of ways. One is to scan like I showed you. The other one is to take a 15 and a 5 and take my main list and just press them, all of them. I start at the most volatile and I see if anything has a, some kind of bullish or bearish structure. And this is what I mean by slop. What does any of this show you? Doesn't show me much. Like I said, I'm trying to be picky. So that maybe Costco. The biggest problem is the broad market has that red candle. But yeah, that's more like what I'm looking for. So I'll just press it and I'll do this all day. Now you might say, why not service now? Because of all the support right here in that area. But yeah, I might mess with that. But that's all I'll do. It's like 100 stocks, and you can just do it this fast, and you see them a mile away. There was one. Netflix has too much support. And all I'm doing with support, it's not some magic, hocus pocus. My first priority is price support and resistance because it's hard to get under that. So I'm looking for the air holes like we saw with Dollar General. So that's all I'm doing is doing this, especially on a day like today where you're not sure it's going to go up or go down. I'm looking for these. And a lot of times, even if I miss it, I go back to see, hey, how could I have seen that one? Hey, there's another red candle. In fact, that one was pretty good. Lululemon's a tough stock to trade, but as you see, it went right to support. So that's what I do is I just go through them and some just stick out. Like Caterpillar. Caterpillar looks a lot better than it did right there. So don't think I'm not looking at bull flags too. So I'll look at bullish patterns too. But once I see this, the next thing I do, I'll go to an hourly. And yeah, the hourly looks okay. It's just hard to get over that resistance after a big red candle. But if I was buying anything, it would probably be a Caterpillar. And any stocks you want me to look at. So, just let me know on those. I'm happy to show them. Now, Popeye, I want to show you something interesting. Let's say that you want a weekly squeeze. The problem is that a stock, let's say a $5 stock, if it doesn't have a shorter term squeeze within the weekly squeeze, you might be stuck in the stock for a long time and eventually be right, but it might occupy your equity. So if I do anything, I'd probably want a daily squeeze and an hourly squeeze. Now, that doesn't mean they're bull flags, but I'm just saying I'd rather have a bull flag within a bull flag for me to do a swing trade. Does that make sense? No, like I said, I don't scan for head and shoulders patterns. 80% of what I look at are continuation, and that's what's made me money. On the other hand, if I see a bull or bear flag form a head and shoulders or an inverse head and shoulders, sure, I'll look for that, but I don't scan for those. I'll scan for rounding patterns and all that, but overall, my go-to is the bull or bear flags. So I don't really scan for those. So, but and answer your question. Okay, let's look at RTX. Good question. Now, there was a real problem with the quotes a couple of days ago, so you got to correct all these bars. There. Now, when I'm looking at these and I don't want to day trade, I'll use 6 time frames. So I'll go in like this and see if something sticks out. There, that's a little too many lines for you. So let me show you what I'm looking at. So, in there, I don't know if I have enough time to go over that, but Popeye, what I'm doing is I'm building a Twitter feed with all the like the CNBC and all that stuff. And if I have time, I'll go over that. Sure. But let me get to these stocks first. So here's RTX. See that one line? It's ruining everything. But basically, if I want to buy this, let's say long term, I'm going to want to have a weekly, a daily, a 4 hour. And like I said, that stupid thing messed up everything. Like an hourly, a 15, and a 5. That gives me sort of a perspective of the stock. So short term, if it gets over this 105, it could go a lot higher. There. You see what we're talking about. Over that, there's no resistance. It's one of those that, if it gets over this candle, probably everybody's going to pile in and then you can have a tight stop. So that's one of them. So, like I said, triggers a break of the bull or bear flag, not the MACD. It's the break of the flag. And combining the overall market. The overall market's breaking up, and I see a bear flag breaking down. I'm not going to mess with it. So the market was going up Friday. You buy on the break. But there's a little trick to that. But let me get to the other two you were asking. All right, Shopify. And then I'll show you. Just remind me in a minute, and I'll show you. All right, what do you do with Shopify? We know that it's acting great now as one of those tax loss specials where everybody was selling into the end of the year. Now, definitely over this, it could go a lot higher. I just, like I said, though, it really depends on the bond market. So, in there, yeah, ask away. It's now, don't get me wrong, Mold. I will look at them when I'm scanning all my stocks, but it helps me a lot if there's a bear flag that would complete the head and shoulders. So, just keep that in mind. But Shopify sure could go higher, but it depends on this. If the bond market has another leg down, then I'm not leaning into Shopify. So I see your point, but that's why this is so important. Because if the bond yields go higher, they'll value Shopify less. That's how I look at it. Now, Philip Morris, I never trade well. This doesn't tell me anything, unfortunately. Another one with a weird thing. So let me take that out. There. That just doesn't show me anything one way or the other. Probably a good dividend stock because it's stuck in a zone. The only problem is it has earnings, and it has earnings coming out soon. So, on February 1st, but I can't tell a thing from that. So just keep that in mind. Now, you were asking about the trigger on the MACD. Well, I use a trigger on the break, not on a MACD. So if I went back to Dollar General on that hourly chart or the 15-minute chart, I'm going to buy when it breaks right there. But this is a little trick. The tighter the pattern, the tighter the stop. So darn right, you could try to buy in here as long as you have a stop down here. A real tight stop. So you're talking about a 30-cent stop, but if you're right, you're going to make that amount. But usually in practice, I try to buy it over the break. So I hope that helps. And Popeye, fundamentals, like I said, I just go to like TweetDeck and add things. So I'll show you. But first things first, SPX, because that could be relevant. So let me go back to the normal charts I had up. And this is one of those times, I'm not trying to cop out here, but when I'm watching the SPX or the ES up here, and the 5-minute is here, I can't do a darn thing. Because on the one hand, if this breaks up, it could go to here, which then could go to here, and then this could go to 4,100. So I can't tell a darn thing except it doesn't look bad. I'm not saying you have to buy it, but if you do, you got to have a stop down here. But overall, it looks pretty good. I would also watch the advanced decline in here and see if that starts improving. So that's what I do internally. So if you see this little rally like you're seeing, you want to see the advanced decline, at least on the New York. You can use the over the NASDAQ, but as you see, it's not much of an oomph. Now, that being said, if this stays in this zone like you're looking at on the 5, and this breaks up out of nowhere, yeah, this is more likely to break up. So that's what I'm looking at. Now, one last thing I'll show you, because I think this is really cool. In fact, I'll show this first, and then I'll show you how to build the TweetDeck thing. So just to let you know, I gotta do this. I'm supposed to do it. I'm having a chart pattern secret class February 11th, and you get like 4 days of live trading. And the other thing that's nice is you actually get, for the price of the class, you get 3 months of me, where I'm on at least an hour in the morning, hour in the afternoon, I do a video 3 times a week, and I jump on all day. All day I jump on if I see something. So basically, you're getting the class for free, and me for 3 months, the class for free. And it's going to be a 4-hour class. I had to show that, so I showed it. So next thing, how do we build the TweetDeck list? So I think this is a really important thing. I know a lot of you buy like Fly on the Wall or something like that, and I just think this is a quicker way to do it. So in answer your question, Popeye, I'll show you. So all I'm doing in here is going to TweetDeck. You got to obviously have a Twitter account. That's fine. You then go down to here to plus. Can you see that on the screen? Can you see that? I'm looking. Yeah, it's tiny, but it's on the left. So you press the plus. Then you go to list. And then you create a list. I have like Asheville Real Estate, Atlanta, Kim Kardashian. No, I don't have Kim Kardashian. I have mainly just Atlanta sports, Chicago sports, and so on. You press create list. And let's just say news 1, 2, 3. And public, you don't care. It could be public or private. Then you press save. So then down here, you want a column. You click, see the add column. So you add the column. And then over here, you take Wall Street Journal. And then you press the plus. What did I do with it? Let me see if it's over there. Let me do it again. And you put Bloomberg. It's just an aggregator. Now you added a column. You can add as many as you want. I don't add too many because then it's just so many you can't, it scrolls too much. Now you press done. And look what happens. You got all of those on the right. All of that. It's a great way to do research in the morning. So, Popeye, I hope that helps. But that's how I find fundamental stuff a lot, is by looking at the news like that. And also, I watch this. Here's another trick. I go to FinViz, free. And when fundamental, like I said, I'm obsessed with bonds moving. So I go to futures. This is just finviz.com. I haven't even logged in. You go to futures. And then you press charts. And that gives you sort of a running thing about the broad markets. And then you can go down here and see silver. You can see platinum, copper. And there's your bonds. So the bonds had a rally and the ES had a rally. But go to a monthly chart and it's a whole different animal. Look at that. So that's just a quick way. I use the TweetDeck to scan for news, and I use FinViz to look at futures charts, and I'll do screens. And, I'll do like, well, let's see this one. I haven't even done this one. Mulder. So let's try this. I don't know if it works. I don't trust a lot of these head and shoulders like pattern recognition. But let's just try it. We'll take stocks over 300,000, industry X funds. You can see that, right? All right. Now, I'm not telling you this is going to work, but let's go to technical, and it says pattern. And there's your head and shoulders. Yeah, I don't believe that they're none. Let me just put it that way. Let's try an inverse head and shoulders. There, it has 10. And you can actually hover over it. See, I don't call those really good inverse head and shoulders. But it's really cool to have it there. So I just thought you'd like to know that it's there. So everybody, thanks for listening. I know we went over. Are there any other stocks you want to see? Because I sure could have missed it. Hey, here you go. We were just talking about this. Look at the advanced decline pop up before this did. So when to answer your question, it looks a lot. It looks okay. Now, if this had plummeted, I wouldn't believe this. But if this is right, you're talking about this going up another 10 points. That's sort of a quasi flag. Now, I call these slumbering bull flags. And what I mean by that is it's not a sharp move up. It's more a gradual move up and then a gradual consolidation. So that's a slumbering bull flag. So, like I said, I hope this helps. Boeing, I hate looking at Boeing. No offense to you, but I liked it 130. And, it's just tough. What now? And that's a great question on your part, because is it a bull flag? Is it a bull flag? Or is it against resistance of all these people that got stuck? Theoretically, it looks like this to me, that you just got to draw a line at the prior tops and figure those are zones. But it could still go there. I mean, it still looks good on a chart. You haven't had any kind of reversal pattern. Now, if you do get something like this, where a red candle takes back a green, you just got to stop yourself out and get out. But so far, it's still in an uptrend till proven otherwise. That's the way it looks to me. So in here, how about Amazon? See, here we go again. That sure looks, and let me take off all these lines. Now, let me just tell you, I've seen this a million times. This has a habit of doing nothing until earnings. So it'll do these indecision candles for like 3 days because everybody's nervous about the earnings. But theoretically, if it could get over this, that red candle, see those big red candles I talk about? Look how much damage it caused to stock from the big red candles. Now, I'm not talking about the one on the downside. I'm talking about as it's rallying, it has that candle. But over that, sure, it could fill the gap at 110. So, pretty cool. So, everybody, thanks for listening. And I hope you enjoyed this. It's just sort of a taste of what I'm going to be going over. There's a lot of different kinds of factors that determine whether something's going to work or not. And there are also other scans you can do too. So thanks again for listening.